first of all, it's important to say that we're seeing a shift. It's like a more of sentiment shift, as you pointed to as well. Our personal customers becomes more optimistic. They see more in terms of stability of income. Real wages are expected to start to increase already this year. We haven't seen the full effect of that yet. The Norwegian economy continues to perform very well, show resilience. We have low unemployment, and also the investments moving into the petroleum industry has, of course, been active throughout the year. But we also now see an uptick in investments, and especially in terms of anticipated investments in the mainland economy, which is, of course, positive. In addition to that, we're seeing an increased activity relating to the corporate sector, relating to commission and fees. We have an all-time high result in commission and fees, predominantly stemming from, a broad range of different products, but you see a significant uptick in debt capital markets, where we see an increased activity in the bond market, but also M&A activity and equity capital markets. In addition to that, people continue to save in Norway. We have an increase in asset under management, net inflow from both institutional customers as well as retail customers. And of course, the stability in the Norwegian economy is important for DNB, being a reflection of the Norwegian economy overall.
Ida, that said, interest rates can catch up with populations, and I just wanted to dive into what you're seeing in terms of those credit impairments. I can see impairment provisions around 81 million Norwegian kroner, which seems to be slightly in line with what you've had in various other different periods of time. Can I just ask you about any change that you're seeing in the ability of customers to repay some of their debts?
In personal customers, we're actually seeing the opposite. I mean, we're not even at 2019 levels when it comes to forbearance or request for installment holidays. And the number of requests for installment holidays has gone down this quarter from low levels already previously. So in the personal customer segment, we're not seeing any negative signs. And it's important to say that the latest repricing towards the customers was implemented 20th of February. So it's really this quarter that our customers see what the level of the interest rates are on their mortgage rate, on their mortgage lending. If you look at the corporate customers, where we take impairment provisions of 480 million this quarter, there's no structural changes there. There are no industries that are more exposed than others, apart from what we pointed to before. Construction industries are, of course, affected by the fact that there's lower activity related to construction, but also there we see a bit of a shift. There's actually new projects being initiated in terms of new builds, which is positive. There's a stronger activity in the property market, which also brings in loan volumes into the personal customer segments. But looking at the impairments that we're seeing in corporate customers, those are customer specific, and they come from a broad variety of customers in small and medium-sized enterprise, but also large corporates. But no structural there either.
Yeah, Ida, one wonders then about the housing market as well. I mean, prices continue to rise a little more than expected there. Does that become a worry for you, particularly still in this high rate environment, or is that just a symptom of what is a resilient environment that you keep getting this increase in those prices?
I think we have been surprised to see the resilience or the increase in housing prices already last year, where we didn't see a drop, but more of a stabilization in 2023. And of course, housing prices has increased by 8% year to date in 2024. Is this sustainable over time? That's difficult to say. And you know that's, of course, just increasing housing prices is not good unless there is a strength in the economy and that also see that there's growing real wages. So the fact that we're now seeing a shift in terms of the consumers are more optimistic. People have work. I mean, unemployment levels at 2% means that people have a stable income also looking ahead. And also there are too little new builds being made in Norway for a very long time. So the demand is still significantly higher than the supply, and we need an uptick in new builds in properties. And then we will expect to see a decrease in the increased housing prices. But again, our economists expect the housing prices to continue to increase in the years to come at levels where we are today.